And this would be, let's say, an introductory session on what KPIs are all about. The next webinar is dedicated to going through more advanced topics such as KPI selection techniques and balancing techniques of KPIs. Now, regarding my profile and the work that I've been doing in this field, Ali already mentioned my background and my formation. I believe this has a role to play in, let's say, the worldview around KPIs. I am trained as an economist. I have a degree in marketing communications, and I've been doing research in this area for the last 6 years or so. So my view around KPIs is driven by the respect I have on database decision making, and also is driven by the importance that I see that KPIs have in facilitating communication. So I look at KPIs as communication tools as well. Regarding the work that I've been doing in this field, there are indeed several organizations I've worked with, both in terms of training and consulting. They were great learning experiences as well, because every project has a new challenge, and every project comes with a different context. There are many things that can be learned from a variety of industries around KPIs. Learning from all these projects enabled me to develop the basis of smartkpis.com, which is at the moment, I would say, the resource with the highest quality content around best practice in using KPIs. Especially the premium section, which contains about 7,000 examples of KPIs documented with definitions, calculations, and out of these 7,000, another set of 3,000 are documented on 2 pages in about 40 fields with sample targets and further advice on the use of KPIs. Now, coming back to today's agenda, understanding key performance indicators, there are 5 main topics that I want to cover. The role of KPIs, KPI definition, the definition that the KPI Institute came up with, along with presenting an overview on how metrics, KPIs, key risk indicators, and analytics are interconnected. Then we'll talk about KPI naming standards, which is something that the KPI Institute is currently promoting, using a rigorous approach around naming KPIs. And finally, we'll look at some case studies, some examples on how organizations can generate value from KPIs. So ultimately, it's all about making sure that these tools help ourselves, help our organizations, and that we don't become slaves to these tools. Regarding the learning outcomes that we will be covering, they are listed in the second column on the screen. So I want to ensure that we'll position KPIs in context as management tools. Also, we'll clarify terminology. So by the end of this session, I expect you as participants to have a better idea around how the different terms that we use in performance architecture are interconnected. And also, we'll talk about understanding the benefits of naming standards. Finally, I want you to become familiar with some of these case studies that I believe add a lot of value in understanding KPIs. So let's get started by looking at some examples of KPIs. So it's all about starting with having the end in mind. We keep talking about KPIs. What I have on the screen are the most visited KPIs in our database in smartkpis.com. By the members of our community. Hospital bed occupancy rate continues to be one of the most visited KPIs, but we have a variety of other examples from both functional areas and industries listed here. Secondly, I developed a list of about 10 examples that I think are widely used in organizations that we can take a look at. The net profit rates. I have here some comments around how we should look at this example. Revenue, sales revenue, for example, for organizations is one of the things that is oftentimes tracked. Now, very important in regards to this, a lot of emphasis is placed these days on cash flow, especially with the difficult economic conditions in a variety of markets. It's one thing to have paper profit, and it's another thing to actually have money in the bank. So in addition to looking at profit rates, profitability, we also need to keep an eye on cash flow related indicators. Regarding the customer perspective, we have selected here two interesting KPIs. One of them regarding percentage profitable customers. So it looks not only at customer numbers, at market share, for example, but this KPI assesses whether we do have a quality customer base. In addition, the Net Promoter Score, which is a trademark by Stratmetrics, is a KPI with a wide appeal due to its simple data gathering process. It's based on one single question. There are several proponents that argue that it's a bit too simplistic, but it needs to be complemented by other KPIs such as customer satisfaction and even in-depth, let's say, mystery shopping analysis surveys. But as a KPI, it is a valuable indicator to use, and you'll probably find it quite often on customer evaluation forms, either at restaurants, at hotels. I find it quite often these days, websites, and also at training courses, conferences. Good. Next, we'll take a look at on-time delivery. On-time delivery is, again, a very popular KPI in terms of logistics, and it transcends industries. So we can apply one variant of this KPI in, let's say, in the airline industry, on-time arrivals. And then we'll continue with taking a look at other operational KPIs, such as projects on time, on budget, according to specifications. Percentage processes optimized is a very popular KPI in organizations. And finally, some KPIs as part of the learning and growth perspective, employee engagement, proposed improvement ideas for employee, and investment in learning for employee. Good. So these are some examples of interesting KPIs that would frame our discussion. This is what I mean by KPIs. This is sort of examples. Next, we'll continue by looking at the role that KPIs play in organizations. This is one of the questions I usually start my workshops with. Well, why do we need KPIs? What sort of value would they add in organizations? Based on aggregating examples and clustering responses, I gradually realized that there are three main roles that I would say KPIs play. One of them is clarity. So KPIs crystallize the data relevant to organizations to reflect the big picture. So in a way, they are crystallizing tools. They structure everything a bit better to provide clarity. Secondly, KPIs enable us to focus. They enable us to place emphasis on what matters. As we can look at the results that are in red, and we can say, yes, these are priorities, we need to address them. They also facilitate, in a way, management by exception. If the results are in green, we don't have to look at these results on the short term. We can eventually monitor them from time to time. And finally, KPIs are all about improvement. They facilitate and inspire the achievement of desired results, which is all about performance. So to me, these are the three main ideas. They are three easy to remember words: clarity, focus, improvement. Very inspirational and very useful in, especially in senior executive communication. Next, we'll take a look at the role of KPIs from another point of view. The KPIs are the blood, they represent the blood that irrigates the performance management system. As we do need data in order to make managerial decisions, smart managerial decisions, in order to manage performance. From another point of view, in addition to facilitating performance management, KPIs act as communication tools. The metaphor that I would use here is comparing KPIs to pheromones. And I have on this slide an example of how feral ants communicate by using pheromones. They leave pheromone trails that they can read and figure out whether they should follow or not. Well, similarly, KPIs inform the organization on what is important, what needs to be emphasized, whether we are on track or not to achieve desired results. And they facilitate decision making as well. Good. So in summary, clarity, focus, improvement. KPIs represent the blood that irrigates the performance management system. At the same time, KPIs can be compared to pheromones as tools that facilitate communication. Now we're ready to take a look at the definition that we established as part of our KPI management framework. We look at KPIs as representing a measurable expression for the achievement of a desired level of results in an area relevant to the evaluated entity's activity. The definition might seem a bit generic, right? We're not talking about objectives, we're not talking about companies, and the reason why is that KPIs can be used in a variety of scenarios. We identified close to 18 scenarios in which KPIs can be deployed in organizations, from service level agreements to the use of KPIs as part of balanced scorecards, the use of KPIs as part of supplier scorecards to evaluate supplier performance. We can use KPIs in our personal lives, so we are getting very close to the New Year's Eve. Lots of people set up New Year's Eve resolutions. Well, some of these can be based on KPIs. So there are a variety of scenarios, a variety of entities that set up KPIs, and we wanted to acknowledge this diversity of scenarios. So in summary, a measurable expression for the achievement of something, that is all about indicating something. So data that indicates something. A desired level of results is all about performance, and an area relevant to the evaluated entity's activity, it's all about being key, representing something that is of relevance. Continuing from this definition, I want to touch on an interesting report that I found in, or an interesting table that I found in the annual report of the Department of Climate Change and Energy Efficiency in Australia. In their annual report, they have this table which lists the so-called key performance indicators with their 2010-2011 result. One of them is listed as timely quality information to the multi-party climate change committee. Evaluated by the department provided timely and high quality information. Well, to me, where is the data in here? What makes the authors of this annual report to say that they actually provided timely and quality information? We want to see some figures here. The average time it took to process some requests, percentage requests completed within a certain time, some trend analysis month by month, the volume of work that was done. This is the sort of data that informs. What we have here in this table is rhetoric. And usually the public service is very good at hiding data behind nice-looking words. So to me, the concept of qualitative KPIs is a flawed concept because KPIs are supposed to be about data, about measurement. We want to see numbers in there. Also, in addition to this, if you look at the second example from the bottom, we have National Carbon Accounting Toolbox, NCAT, implemented for forestry and agriculture, listed as a KPI. This is actually an initiative. It's a project that this organization wants to implement it or wanted to implement in order to achieve something else. The question is, why do we want to deploy this toolbox? What do we want to achieve? And then let's see how we can measure the achievement of that specific outcome facilitated by the release of these outputs. So the toolbox itself can be seen as an output. People that receive this toolbox might just throw it in the bin. They just don't care about it. So then the fact that we launch a toolbox doesn't mean that we are actually achieving the business outcomes that we are supposed to achieve. So this table contains an example of an initiative that is listed as being a KPI. It contains an example of a statement and qualitative statement that is listed as being a KPI. In summary, we should avoid the concept of qualitative KPIs because they actually add limited value. KPI should be all about data and making decisions based on this data. Next, let's expand this discussion around terminology by looking at examples of, let's say, screenshots from a variety of environments. The Jeddah municipality has a website which contains a list of KPIs. The Audit Commission in Scotland calls them key performance indicators. Other organizations call them indicators or performance measures, metrics. The next slide actually presents some live links to organizations from around the world which use different terms for pretty much the same concept. So what happens in practice? There is quite a bit of confusion around what is the difference between performance measures, indicators, key performance indicators, key result indicators, key result areas, and so on. The next slide presents some of these terms that I continue to find in reports, in materials, and two options that organizations have in deploying such terminology. Option which is the traditional option that has been promoted for a while by several authors, is the so-called onion approach with several layers. So we have a variety of measures in organizations. The most relevant ones that reflect performance are called performance indicators, and then we have, let's say, the more selective ones, about 20 or 30 of them, we would call them key performance indicators. And finally, key result areas or key result indicators at the core, maybe 5 or 6 of these. So this is option one, a structured approach in which what we have to do is to differentiate, to have definitions around each of these concepts. Option two is a simple architecture built around metrics that inform decision-making, decisions, and KPIs, which are all about evaluating performance. So the structure is based on metrics and KPIs. Now, out of these two options, my preference, as you probably figured out by now, is option two. I'd like to keep things simple, start with things simple. If several stakeholders in organizations prefer a more complicated architecture, the burden is on them to justify why such a complicated architecture adds more value. So as a result, I would say my advice is let's start simple with a simple architecture and see about how that works. And if necessary, and if the complexity of the environment requires the use of a more complicated architecture, we might deploy such a thing. The next slide presents an overview of the relationship between metrics, KPIs, KRIs, and analytics. The way I would look at this is, as people, we like to measure. We've been doing this since antiquity. We've been measuring in astronomy, in finance, taxation. We've been measuring in physics. We have a variety of sciences that are all about measurement. So in terms of measurement, this is done by quantifying several variables, by counting pretty much something. So let's say we have a variety of things that we can measure in life. We can measure air pollution, we can measure air temperature, we can measure the depth of rivers, of sea. So there are lots of things we can measure. And I would call this the data universe. We live in a universe of data. The moment some of these measures are relevant to the organization and we deploy them in an organizational context, they are elevated from the status of metrics, things that we measure, to two main categories. If these metrics, the things that we measure in life, reflect performance, they become key performance indicators because they reflect performance. If they reflect, if they support risk assessments and inform risk management approaches, they become key risk indicators. So the generic metrics that we might have in place, we can actually brainstorm in a session we can come up with, let's say, 500 examples of things we can measure. But lots of these examples might not help us in terms of improving the performance of the organization. For example, the average temperature in an office environment might not be relevant to the organization's performance. So it's a metric, but it's irrelevant in terms of its performance. So this is why grouping metrics into KPIs and KRIs helps, because they actually fulfill a higher role, a higher mandate. They are not just things we measure, they are things that we measure for a purpose, to inform performance assessment, to inform risk assessment. And finally, once we look at trend analysis, once we play around with data, we do some modeling, we try to identify trends, we are doing analytical work. And the term predictive analytics is all about looking at data that we have available, KPI data, KRI data, to gain insights from this. So to me, this graph illustrates the relationship between metrics, things we measure, KPIs, KRIs, and the moment we use this data to get meaningful insights, we process this data as predictive analytics. And now we are ready to take a look at some examples. One example we have here on the screen is CRAP. I'm not a big fan of the term because it might not be easy to understand. It's in essence about, let's say, work residues or redundant material produced as a result of a manufacturing process. Now, it is a KPI because it illustrates performance in an organizational context. It illustrates the quality of our production processes. The graph here also illustrates the trends. At the moment, it's a trend that doesn't go in the right direction, because the trend would be good when the results would be decreasing. At the moment, the results are increasing. So we can also do some analytic work around this KPI. Next, let's take a look at an example of a key risk indicator. Lots of organizations have problems with write-offs of accounts. Billing customers, sending out invoices, delivering merchandise, and then not getting paid. If this problem becomes really serious, it might result in bankruptcy. Now, to provide an early warning around such accounts that are in danger of being delinquent, the solution is to identify this as a potential risk and monitor it through a key risk indicator. The key risk indicator here, the example is percentage large customers in financial difficulty. So if we identify the fact that, let's say, a large proportion of our business is done with 10 large customers, then we can say, let's monitor their bonity, their financial stability, and take action in case some of them consistently have financial problems. Actions such as changing the terms of credit, or even looking at proactively looking for an alternative customer base. So there are various things we can do to proactively approach this risk of them not being able to pay us anymore. This key risk indicator doesn't indicate our own performance. It is used to indicate the risk of our main customers having financial difficulties. And finally, let's take a look at an example of analytics. This is a screenshot from Google Analytics that represents web traffic. So the number of visits on a particular website in a month. Now, by looking at this trend, there is an opportunity for us to identify the best day of the month to send out a newsletter, or actually the best day of the week if we decide to send this on a weekly basis. It's quite easy to pick it up. As you can see, there are 2 days in this graph in which the web traffic slows a lot, and these are Saturday and Sunday. But the traffic decreases starting with the middle of the week. So Thursday, Friday are days in which traffic already decreases. The peak is on Tuesday. So the solution here, by doing this analysis, is to decide the best day of the week to send out a newsletter would be Tuesday, because most of the people visit websites on Tuesday. And well, the connection is that by sending a newsletter, you expect these visitors to click on the newsletter and to open up a website. So that means that they are online, they are connected, they have the time availability to visit this. Monday is not such a good idea because in many countries Monday is a slow day, either due to meetings, lots of meetings taking place on Mondays, or due to people not coming back to work after a long weekend. In Australia we have a tradition, the Australian sickie, that generally takes place. It's a disease in Australia. Lots of people working in the country get sick either on Fridays or on Mondays. This way they have an extended weekend. And the result of this is the workforce attendance in organizations in Australia is affected. This is an extract from the Centrelink Annual Report 2010-2011. Unscheduled absence leave was at 13.77 days for an entire year. A small increase on the previous year result, but a significant improvement according to the authors of this report from the peak of 15.88 days. Well, is it really? If we take a look at the next slide, we'll see some work done by researchers in the field, some authors in the field. It is estimated that on average in Australia, the graph in the middle of the screen shows that on average we have about, let's say, around 9.5 days per employee per annum. So 13.8 is already higher than the Australian average. But more than that, it is considered that an acceptable level of absenteeism is an average of 6.5 days of sick leave per year. So that's half the number of sick days per year that Centrelink employees generally take. So again, an example where a government annual report, a public service annual report, has the rhetoric in letters, but doesn't provide the trend analysis, doesn't provide the comparison, doesn't provide the context to actually put these figures in context and make them more meaningful. Now, we are ready to take a look at some examples of statements that we have to see whether or not are KPIs. The first example, it is a KPI. It's about employee satisfaction, one of the most visited KPIs. Second example, turnover. It is a KPI as well. However, here what is important to note is we are talking here about financial turnover. So a better term for it would be revenue, sales revenue. If we would be talking about employee turnover, the symbol in front would be a percentage, and we would have the term employee there. Finalized project by 31st of December is actually a milestone. It's not a qualitative KPI, it's not a KPI. It might indicate performance, we can evaluate performance for it, but it's part of a project, milestone in a project, a deadline. New clients from referrals, yes, it is a KPI. Number of employees, generically it's a metric, because number of employees by itself doesn't really reflect performance in itself. So it's not necessarily a KPI. However, there are two contexts in which this becomes a KPI. Context is when we go through an aggressive growth phase. So we hire lots of employees, and we might have an objective around ensuring workforce availability in line with our growth plans. As part of this objective, we will be measuring number of employees. We can set up a target. 2,500 employees is the target. The current actual is 2,000, so we need to bridge this gap and hire 500 more people in a certain period of time. So if we have a strategy around growth with a specific number of people we have to hire, yes, it becomes a KPI because it evaluates the performance in implementing that strategy. If we don't have such a strategy in place, we might have another type of strategy, which is about staff reductions. I've read recently about Citibank reducing its global workforce with about 10,000 employees. Well, I would think that they have an objective in place around restructuring and optimizing workforce allocation in line with our new direction. And as part of that, the KPI can be number of employees. At the moment, we are at 100,000. By the end of next year, we want to be at 90,000 employees. Good. Percentage projects on time and on budget, certainly it's a KPI. Superior quality services. I would look at this as value driver, especially quality. The term quality here is a value driver. So it's not an objective, though. An objective traditionally starts with a verb. So to convert this into an objective, you would have to put in front deliver, deploy, provide superior quality services. Next, we have number of defects, a very popular KPI as part of process improvement initiatives, quality improvement initiatives. And number 9, budget is not a KPI. The fact that an organization allocates $1 million in budget to its marketing team doesn't reflect the performance of the marketing team. The marketing team has to demonstrate financial discipline in spending this budget in accordance with its forecast. So converting this metric into a KPI would be done by changing it to percentage budget variance. So budget variance would be a KPI. A target would be at organizational level plus minus 3%, 5%, at project level plus minus 10% generally. But budget in itself is not a KPI. And then we have number 11, increase current market share with 20%. I already anticipated the response to this one. It is an objective. So the way to filter through all these is by looking at the definition. A measurable expression for the achievement of a desired level of results in an area relevant to the evaluated entity's activity. Now, what we can identify here as a pattern is the use of symbols in front of KPIs. Now, not all the metrics that have symbols in front are KPIs, but there are certain standards that can facilitate the differentiation between terms such as objectives, KPIs, and initiatives. So this figure represents some of the concepts we talked about previously. Value drivers, objectives, KPIs, initiatives. Goals and themes are clustering tools that group objectives to make them easier to process. So let's take a look at the terminology we might want to use to reflect objectives, KPIs, and initiatives. Objectives should start with verbs, action verbs. Maintain, improve, achieve, develop, grow, and so on. Initiatives at the other end should start with nouns. The reason why it's useful to start with nouns or even adjectives is because we want to provide a differentiation between initiatives that are supposed to develop to offer us outputs and objectives which are about what are the final outcomes we want to achieve. So in order to avoid confusion between initiatives and objectives, initiatives should focus on the outputs that these projects, let's say, will generate. In the middle we have KPIs, and the standard terminology that we rolled out in Spark KPIs have over 20,000 examples of KPIs that use this standard terminology is the following. We should use 3 types of symbols. Value of, so the dollar value in a way represents the value of, the dial sign represents number of, and the percentage sign represents percentage of. Now as part of this standard, I wouldn't encourage the use of the term of. So all we have in our database are just symbols. We don't have the term of because it's just repetitive, it fills out space, and it doesn't fulfill the principle of efficiency, which is at the core of performance improvement. So if we want to be more efficient, we need to express the same content in less words. If we can get rid of if we can get rid of words such as total, average, then we make better use of the real estate, and we can achieve the same meaning by getting people used to the use of the terminology. So in the right column, we have several such examples: sales revenue, the value of sales revenue, number of defects, and percentage of processes optimized. I also listed here the star symbol, which is linked to qualitative statement. It's a qualitative statement survey. For example, employee engagement is measured in many organizations once a year. Now, in the meantime, there are many things that might change during the year. Some people argue we shouldn't measure more often because things don't change that often. On the other hand, there are people that say we shouldn't measure more often because it costs money and we don't want people to be surveyed out, too many surveys to fill out. Well, it does help to get some sort of pulse check of the morale of staff. And this can be done, for example, by asking managers to write in one simple sentence how they would describe the staff morale in their team in that certain month. Now, this description would be a qualitative description. It's a statement. It's a surrogate to actually measuring the KPI, but still it provides us with a litmus test of where are we at in terms of employee engagement. Are we on the right track? So I gave here an example. Staff morale is low due to the low standard. I don't consider it a KPI, but is a surrogate to complement a KPI that is not measured with such a high frequency. In some situations, it helps to deploy such statements. All right, so we are ready to take a look next at objectives. Probably some of you looked at the list of statements and confused some of those KPIs with objectives. Well, to me, objectives can be simple statements. As long as they start with verbs and define something we want to achieve, they don't have to be complex. For example, increase market share can be a corporate objective. However, there is this discussion around what is a SMART objective. And yes, we are all familiar with the SMART acronym. I'm not going to go through it, what SMART means as part of this SMART criteria. What I wanted to do is something different, is to decompose this SMART criteria into components that we can build around objectives to make sure that they are SMART. So what we have on the screen is a quality assurance check around objectives to make sure that we set them up correctly. Now, increased market share is not a SMART objective because there are several components that are missing. But the moment we put in a KPI linked to this, a target linked to this, a time frame by when we want it to be achieved, and the responsible for achieving this, this objective becomes a SMART objective. Now, we have two options: to build all these content into one single phrase, such as the one at the top, increase current market share by 20% by financial year end under sales manager's leadership. Option two is to build all this content in a scorecard that is linked to the list of objectives, such as the strategy map. And then the strategy map plus the scorecard together provide the quality assurance mechanism to make our objectives SMART. Many strategy maps, if you look at them, contain just objectives. They are not very detailed objectives, so they are not SMART objectives. The moment we attach a scorecard that measures them and has all these details listed, these objectives are transformed into SMART objectives because they are complemented by the scorecard. So this is the solution I would recommend. Again, keeping things simple. Let's not confuse people with very complicated objective statements. We can have simple objectives. As long as we attach to them a scorecard, they become SMART objectives. Good. So far we covered what KPIs are all about, what objectives are all about. This is an interesting case study. I looked at the Panama Canal Authority recently. As part of our research, we look at annual reports quite often, and I found this interesting because they are listed as corporate goals. To me, they are not. There are two tools that we looked at so far that are listed here, two main tools. One of these tools is the initiative, and the other one is the objective. So some of these statements are initiatives, some of them are objectives. Built in, certainly we have KPIs, we have some targets, we have milestones, but let's take them one by one. To obtain profit, corporate goal number one, obtain profit before interest, taxes, depreciation, amortization. It's actually an objective. Number two, it's an initiative, it's a project. Let's set up a new pricing structure. Why do we want to set it up? Because we want to achieve certain things. Number three, it's a project. Develop a preliminary report. Number four, it's a project. We actually have it listed. Third set of logs project. So I don't call these corporate goals. They are mostly initiatives. The question is, why do we want to get all these things done? Well, that answer will provide us the actual objectives, the actual goals. Number five, yes, that is an objective. Number six, that can go either way, either a process improvement initiative, or a project, or an objective. Number seven, it's a project, implementing this action plan, developing the action plan. Number eight, again, it's about a plan. It's a project, initiative. Number nine, it's a plan, it's an initiative. And 10, it's an objective. 11, it is in a way an objective. The concept of indexes is something that generally should be avoided. I don't like this idea of aggregating the performance of a company and having one single figure that each month reflects the performance. Well, that figure will not tell us much. So I would avoid the concept of having a corporate performance index built in. Now, some other examples from practice. Qantas Airlines in Australia, in their Qantas data books 2008-2009, has a variety of statements listed as KPIs. They are actually not KPIs. Reduce electricity consumption, reduce water consumption. Well, there are objectives with some targets. The way we can convert such statements into a proper performance architecture is listed in the next slide. So the objective would be reduce electricity consumption by 10%. The KPI is electricity consumption in kilowatts hour. And the target would be, let's say, 20,000. We can certainly analyze the actuals. Maybe we reduce from 33,000 to 30,000, we can look at what's the variance, and in our commentary we can write, yes, we achieved a 10% reduction. But this delta, this reduction, shouldn't be built in as part of the KPI. The KPI should be about the data that enables us to do some trend analysis. Yes, we want to monitor electricity consumption. Based on this trend analysis, we can provide commentary and estimate how much we reduced, how much we increased, which will reflect the achievement of the objective. But the KPI is electricity consumption. Same here. The KPI is fuel per 100 RTKs. You might wonder what an RTK is. Well, that is a technical term used in the airline industry, and this example actually reinforces the importance of having KPIs documented, because by just looking at this name, you can't figure out what is RTK. Good. So again, the objective is improve fuel efficiency by 16.5%. The KPI is fuel per 100 RTK, and the target is 20,000. Now, Qantas Airlines has some good examples of KPIs in use: lost time injury frequency rate, LTIFR, and aviation CO2 emissions, carbon dioxide emissions. So it represented through some very well-selected bar charts to illustrate the values in time. Actually, even in terms of data visualization, a good practice is to, bar charts are very useful because they are relevant to, and they are well processed by humans. However, in terms of doing trend analysis in time, line charts are preferred. Good. So bar charts, line charts as data visualization options are generally recommended. Next, we can take a look at the value added by KPIs. So we have several case studies. I selected about 4 case studies of how KPIs add value to organizations by looking at the data. The first one is Day Sales Outstanding. Again, DSO is the acronym used here. It's something that by just looking at it, you might not figure out what is it about. So I provided in the middle of the screen the definition as taken from smartkpis.com. It measures the average collection period in days from invoicing to cash receipt. So how long it takes to collect revenue after sales are made. The calculation is listed in the right-hand column. So we have A, B, and C. A divided by C divided by A divided by B and then divided by C. So we have gross accounts receivables by sales revenue by days in reference period. Generally, it comes down to a certain number of days. So reducing DSO from, let's say, 39 to 38 days, in the case of a shared services office, was evaluated as having an impact of $50,000 in savings per year. So by getting our money back from suppliers, from customers, once we invoice them, we can actually increase our profitability because of 2 reasons. On one hand, we can rotate this cash quicker, faster, more often. And on the other hand, we avoid paying interest to bank loans to fund our operations. So in this case, doing this analysis around this KPI helps the management team in making decisions that will affect the company profitability. So it's a very good example to reflect how a KPI informs and helps us in making decisions. What type of decisions? Well, in Australia, there are organizations that, on one hand, charge late payment penalties. In this instance, Origin Energy charges a fee of $12 for bills that are paid late. On the other hand, there are utility companies that offer a discount for paying utility bills on time. So we have both the carrot and the stick approach listed here. The reason why some of these companies offer discounts, so they are saying, okay, your bill is $200 for the last quarter. If you pay on time, you can pay $190. We offer you a discount. Now, the reason why they offer this discount is, on one hand, because by getting the money on time, they avoid, again, funding their operations from bank loans. But also they avoid the hassle of following up with customers that don't pay on time. So you'd have to, let's see, send a text message, send an email, even call, and ultimately you might end up going to a collections agency to recover the money. Each of these contact points will cost money. A text message, let's say, might be 50 cents or $1. Also, calling by doing some activity-based costing can be figured out as being, let's say, $10 if it's a short call. But if you look at the infrastructure cost, the salary of the person that calls, it might end up even more, and so on. So adding up all these contact points will result in a considerable amount, much higher than offering such a discount to customers. Next, we can take a look at another interesting KPI, employee engagement. About a month ago, a new website was launched in the United Kingdom, engageforsuccess.org. It's an initiative supported by the UK government in promoting good practice around employee engagement in the United Kingdom. It is considered to be a factor of economic growth at national level, having more engaged employees. They even have a very, let's say, boring video around employee engagement on YouTube. So you can do a search, Engage for Success, go to their website, look at this video. Now, what is this all about? Over the last, I think at least couple of years, a lot of work has been done in developing the content of this website. And lots of very good research was put into connecting employee engagement as a KPI with the consequence it may have in organizations. So what we have on the screen is the impact that employee engagement has on profits, on customer satisfaction, on productivity, innovation, and employee turnover ultimately. So again, it's about making a connection between employee engagement and the consequences that this KPI has on organizations. By knowing these consequences, we can make better decisions around how we will deal with this KPI and how much emphasis we'll put into improving it. So again, the corrective action here is to acknowledge the importance of employee engagement and put employee engagement as a KPI in context. This is an image, is a figure that is available on the Engage for Success website. It illustrates how the workplace in which we operate in the 21st century is much more complex than the workplace in which people operated, let's say, at the beginning of the 20th century. And in the UK, an engaged workforce is considered key to the competitivity of the entire economy. So it's about facilitating a paradigm shift from the way we perceive workforces and the traditional approach of pay for performance, giving people money to work more and generate better results. Well, these days it's about engaging staff, not through money, but through other means, creating an environment in which they feel appreciated, in which they have autonomy, mastery, and purpose, some of the ideas promoted by Daniel Pink in his book, Drive. And finally, another example from the airline industry, airline sector, turn time or turnaround time. This is all about how long it takes an airplane to take off from the moment it lands in an airport. Let's say a budget airline might want to use the same plane for 8 trips in a certain day. Well, by reducing this turn time by 10 minutes for each of these trips, we can actually squeeze in an extra trip. So from 8 trips, we can make 9 trips. An airline loses money every time an airplane is on the ground. Now, Boeing has done some very good research in this area, published in one of their magazines, Aero magazine, on the impact that turn time has on utilization, airline utilization. So there is an 8% improvement in airplane utilization for each 10 minutes of reduction of the turnaround time. Now, some of these figures that have been quoted oftentimes in research is, for a budget airline, traditionally it used to take about 51 minutes to turn an airplane around. These days, many airlines achieve about 26 minutes, 30 minutes. Southwest Airline, in one case study, was quoted as achieving a 15 minutes turn time. Probably it's a small regional airport, a small plane. But it illustrates that in this industry, which is under a lot of pressure to improve efficiency, the measurement of such a KPI can be connected to financial performance, and it provides the support for initiating projects around the improvement of operations in turn times. Now, the next graph illustrates visually what are the activities that generally take place once a plane lands starting with installing the passenger bridge, refueling the aircraft, and so on. So acknowledging the importance of improving this KPI turn time, what do we need to do next is to understand what actually takes place visually first. Next, we can put everything in a table format and monitor for each activity how long it takes to shut down the engine, to deplane passengers, to board passengers, to refuel the aircraft. So in this image, we have the critical path in orange, and also we have the other activities that we need to try to squeeze in along the critical path to ensure that we can fit the entire turn time within, in this case, about 26 minutes. So this is what airlines have been doing for a while now. They started with 51 minutes, and then they analyzed how they could optimize all these things by setting up new rules, new guidelines, new procedures, to gradually get to such a level of performance. For this reason, I consider the airline industry to be an industry that can be seen as a model for deploying KPIs. As mentioned, they are under a lot of pressure, so they do this not by choice, it's a must for airline industry, for the airlines industry. And an example would be the fact that in June, this article quotes US airlines as delivering the best on-time performance in more than 2 years. So results start to show in the industry based on monitoring of such KPIs. Now, at this stage, I'd say that your views around what KPIs are all about probably have changed, at least slightly. And I invite you, whenever you read materials in the future, articles, books, materials, newspapers, magazines, to try to pick up KPIs in the sentences that you find. In this instance, just by reading this article, I was able to identify 2 interesting KPIs. So we have 86.3% of flights arrive within 15 minutes of scheduled arrival time. 99.7% of all US airline passengers had their bags delivered on time. So some very interesting KPIs that can be monitored. Now, to close off, a quick review of what we covered today. The role of KPIs: clarity, focus, improvement. 3 simple words, very meaningful words. The KPI definition: a measurable expression for the achievement of a desired level of results in an area relevant to the evaluated entity's activity. You'll get used to it. It might sound complicated at the moment, but you'll see that there's merit in each of these words. They were carefully selected. Finally, we looked at linking metrics with KPIs, key risk indicators, and analytics. And we covered the 3 symbols that are essential to be used as quality assurance tools to ensure we select KPIs that are measurable and easy to understand. So I would encourage you from now on to put these symbols in front of each of your KPIs without the letter of, or without the letters ONF afterwards, to ensure that you use a standard that facilitates the understanding of KPIs and the quality of their selection. And finally, we looked at some case studies of how we can generate value from KPIs. DSO, where we calculated the impact of base sales outstanding. Employee engagement, the impact of this indicator, not just in an organizational context, but also at national level. And turn time in the airline industry. Thank you for your interest and for joining at such a late hour in such a festive on such a festive occasion. I will stop here. Looks like that we have 1 more minute left. Well, we'll invite Ali to follow up and say a few words.
Well, thank you very much, Aurel. Folks, now we are open for Q&A, question and answers. If you have a question, you can either raise your hand. There's a hand icon available on your webinar console, and I'll be able to give you an opportunity to speak to Mr. Aurel Brudan. Or you could equally post your question in the chat box, and I would be happy to read them over on your behalf. I see a couple of hands already raised. Before I give you an opportunity to speak to Aurel, I would request you to kindly keep your question short, precise, and brief so we can have maximum participation in the Q&A. Let me start with first I see a number of hands. So I have Jasser Al-Harbish. Can you hear us? Yes, sir. Yes, sir, can you hear us? Raise your hand. I believe we are. Let me move to the other person. We have another one from Mr. Muhammad Karimullah. Can you hear us? Muhammad. Mr. Muhammad Karimullah. But okay. Let me move to the chat box then. Okay, there is a question. Okay, Mr. Karimullah has posted the question in the chat box. How would you measure the employee engagement? How to measure employee engagement?
Indeed, the question oftentimes asked. Now, there are about 5 research companies that develop their own proprietary tools in measuring employee engagement. These are generally surveys that are run by organizations such as the Gallup organizations, Tower Perrin, Hayes Group, and a variety of other research or consulting organizations. Some of these surveys have 150 questions, others have 5 questions, others have 30, 40, 50 questions. So there are there are many ways in which employee engagement can be measured based on these surveys. Other organizations measure employee engagement with one single question. So there's not a set standard. It can be a bit confusing. And actually, in terms of doing benchmarking around employee engagement, you can realize now that it is not such a good idea if the measurement tool, the measurement instrument, varies from one organization to the other. So in summary, employee engagement is measured through a series of questions that are aggregated to provide this overall index. Now, a very interesting aspect around employee engagement, one of the factors that is also monitored when doing such surveys is the percentage of staff members that respond to employee engagement surveys. Apparently, this is a very important factor because their participation in such a survey illustrates their engagement level in itself. So, generally, employee engagement is, are you giving 100% to your work? How dedicated are you to your work? So it's about this type of questions, but certainly they can be broken down into specific aspects that can be evaluated.
Okay. Okay, let's move to another one. Aisha Masood, can you hear us? Can you raise your hand?
Yes. Yes. I have posted the question even on the bar. It's about how do you apply KPIs to an educational institution?
Yes, Aurel, did you understand the question, or you want me to read it over?
Yes, I understood the question. Now, in educational institutions, there are 2 main opportunities. On one hand, we can use KPIs to monitor the implementation of this education institution's strategy. So be it a university, a school, or a K-12 school, or a secondary school, a high school, or even a professional type of school, a trade school. They are organizations in themselves that have to have strategies in place with mission, vision statements, objectives. Well, we need to use KPIs to assess their financial stability, their customer satisfaction, the quality of their processes, whether they do projects on time or budget within deliverables. In Australia, there was a famous implementation at RMIT of a software to be used to keep track of student management. It went terribly wrong. Student records were lost, this sort of thing. So even if you're in an educational institution, you need to manage that institution in a professional manner. So you need to keep track of such traditional business indicators to monitor your strategy. So that is one aspect. The second aspect, as an educational institution, you also need to monitor the quality of your service provision by looking at graduation rates, looking at student experience, looking at literacy and numeracy tests, at the school exams results. Also, you can monitor the relationship with alumni. So there are many aspects that can be looked at as part of, for example, dashboards to analyze specific aspects. So there are two main contexts: monitoring the overall strategy of the organization through KPIs, through performance management systems. The second aspect is monitoring the quality of the service provision by looking at indicators that assess aspects related to the educational services.
Okay, there are a couple more questions in the chat box. There's one from Brother Muhammad Rashid. What are the guiding principles for establishing KPIs by the management for different functions in a manufacturing company?
Number one, I would say it's important to engage the senior management to clarify the needs. Why do they want to do this? Do they have a clear idea of what will be the outcomes that they want to achieve? And also, what is the level of support that they are willing to offer? Ideally, the senior executive, the CEO support should be secured. And the moment the project will start, this senior executive needs to be the sponsor, and the relationship between the project coordinator, the KPI project coordinator, and this senior executive needs to be a direct relationship, direct linkage. Oftentimes I start my implementations when I work with organizations by releasing a message, a memo from the CEO, from the general manager to the rest of the organization to inform them that this project starts, it has my endorsement, and it's something that I want you as members of the organization to support. So that's step number one. Step number two is to ensure you engage stakeholders. So a good idea is to set up meetings with a variety of managers to talk to them about what are they doing at the moment, to provide you with some samples of reports of what are they measuring, to give you a contact person, to be the go-to person in case you need additional information about what they are doing in terms of KPIs. Number three, research. Do your research. Look internally at what is in place in terms of KPIs, annual reports, operational reports. Do external research. Look at lists such as smartkpis.com, at books, at competitor annual reports to see what else is out there. It's not to say that you're going to use this data in your organization. It's just to educate yourself around what is used in place. Number three, prepare a work. No, actually we go to number four. Number four is organize a workshop. You want to engage employees, management. You want to get them to talk, to feel like they are part of this process. You don't want to lock yourself in an office where you come up with a list of KPIs a few hours later. So it's important to organize a workshop, make it dynamic, do some exercises. We'll talk in the next webinar about the techniques that can be used as part of these workshops, building a KPI wall, a KPI expo, doing a value flow analysis, doing a KPI balancing quality assurance exercise. So there are various techniques that can be used during such workshops. And then the next step after the workshop, you would have to document KPIs to make sure you understand them. Days sales outstanding, DSO. You might not have a clue of what this means. So it's not enough to select names. It's important to clarify how these KPIs will be measured as well. After the KPIs are documented, the next step is to integrate them in scorecard dashboards, to build the context, the visualization solutions. And following this, the next step is to activate them, to gather the data. Once you have the data, you can generate the report, and once you generate the report, you can analyze and make decisions based on the data. So these are some of the steps that are part of a project. I would recommend to set up KPIs as part of a project, because you have a start date, an end date, a project manager responsible for this, eventually a budget, and it's something that you can focus on, you can communicate to staff. It's something that has higher chances of being implemented to high standards. If you try to roll out KPIs as part of your day-to-day operations, delays may occur, and you might not allocate enough time, not enough resources, not enough support. So I would suggest structuring this as a project by following the steps that I mentioned.
Okay, there's another question. What is the difference between internal and external KPI?
Well, I guess on one hand, we might refer to, are these KPIs reflecting our own performance as part of our own organization? For example, you'd look at employee satisfaction and percentage processes optimized, percentage projects on time or budget with deliverables. External KPIs might also be affected by other factors in the market, so they would reflect something that is external. We might look at market share, and because it's also affected by other factors that we don't have control over, our competitors, for example. An external KPI might be also around customers, customer satisfaction, as this customer satisfaction can also be affected by other variables that are external to us, not just driven by us. Now, another way to look at this would be, are we measuring our organization or are we measuring others? So, for example, you can have KPIs that measure your suppliers. So, in a way, you can say, yes, these are external KPIs. Now, the best way to figure out exactly what is the meaning of internal external KPI is to actually look at some examples that the person that proposed such a categorization considers to be internal external KPIs, and to see exactly what was the logic behind them. Because oftentimes the terminology itself can be misleading. For example, key KRIs. Some people refer to KRIs as key risk indicators, some others as key result indicators. So same with internal external, it's all a matter of the person that proposes this categorization to be more specific around how this is relevant. Overall, we don't use such a categorization in our KPI management framework. We try to simplify as much as possible. And our preferred approach in categorizing KPIs is input, process, output, outcome KPIs or metrics, and also trend is good when increasing, decreasing within range is very useful as well. Another way to categorize that we don't support a lot is leading and lagging. That is contextual, can be misleading if it's not analyzed correctly. So I would look at KPIs mostly as input, process, output, outcome, and trend is good when increasing, decreasing, and within range.
Okay, let's move to another person. Mr. Iqbal, can you hear me? Iqbal, can you hear me?
Yes, sir.
There's
Hello.
Hello, Mr. Iqbal, can you hear
Hello,
me?
yes, I can hear you.
Could you please ask the question and introduce yourself?
Yes, sir. It's me, Shamim Iqbal. I am basically in fabrication industries as a QA team. So I want basically to measure customer satisfaction, and I want to take KPIs for that one. It is one of our process we are following in our industry.
So basically you're asking...
And the second question is that we are proposing...
Okay, sorry, please proceed.
Yes, sir. So in my basically chat box, there are three things I have asked. First thing is that KPI, what we have to use for customer satisfaction. Second thing is that we are procuring material from suppliers from outside the country also. So if I want to fit KPI on the material procurement in our one of the department, procurement department. Second thing is that to improve our quality management system, we are conducting internal audits during the year, many. So I want to put KPI for that one also. So how Mr. Brudan can help me in this regard?
Right. Now, there are quite a few questions here. Will you be able to just synthesize for me? First, let's take them one by one. What should be the first question?
Okay, Aurel, there was an echo. Let me, I think his first question was how to fit the KPI for customer satisfaction and material procurement in fabrication industry.
How to, okay, in terms of measuring customer satisfaction or aspects that relate to, let's say, customer experience and engagement. Well, we might want to look at not just customer satisfaction as a KPI, which is generally measured by asking customers, are you happy with us? Net Promoter Score is along the same line. So satisfaction is level 1, and Net Promoter Score is about customer advocacy. So not only they are satisfied, but they are willing to recommend you to friends and family. So these are the traditional ones that look at, let's say, opinions of customers of you. But customers vote with their wallets as well. So you can look at percentage return customers that come back and buy more from you again. You can also look at the size of the account, customer account. right? You can have 100 customers that spend $100 each month, or you can have 10 customers that spend $10,000 each month. So the size of the account, you can actually make more money with the same number of customers by increasing the number of products you sell to this customer base. So these are two interesting indicators to monitor. The return customers and the size of the account with them, because they illustrate in quantitative terms their opinion of you. If they continue to buy from you, if they buy more from you, that reflects, in a way, their satisfaction through how they use the wallet. So that is one aspect regarding customer satisfaction. We can also look at defects, returns, these sort of things, the number of complaints. So we can actually build a dashboard around customer engagement with all these examples grouped in clusters. However, in a scorecard, if we want to monitor an objective in this area, we might need to select only 2, maximum 3 of these KPIs. The rest of them can be monitored in a dashboard, customer engagement dashboard, let's call it. So that is the first aspect. Which was the second one in the manufacturing environment?
Let me try to unmute him again. And with the request, Mr. Gawal, to just be precise and short. Mr. Gawal, you
yes,
can.
sir. My second question was that. Yes, sir. My second question was that we are procuring material from. We are basically outsourcing the material, and I want to put KPI on the quality of that procured material for the supplier.
Indeed, I've done
KPI. I want to use.
Okay, I understand now. So here we are talking about procuring materials and monitoring the relationship with these suppliers. It's a good idea to do that, to set up a dashboard to monitor specific indicators that reflect the quality of the relationship. Or in case you want to be a bit more structured, you can set up some objectives for this relationship with suppliers and put together a scorecard in which you monitor each objective with KPIs. Ultimately, it's all about selecting KPIs that you can use to monitor the relationship with suppliers. Now, you can have aspects such as on-time delivery, accurate delivery. So if I said that they sent 10 boxes, did they send 9 or 10? Did they send 10 boxes of green items or black items? So it's the accuracy of delivery. It's another. So we can look at time, quality of the delivery, and also cost. Are they? What is their average? What is their variance from the market average in terms of cost? Are they more expensive than the market average? Sometimes you might want to pay more because you get better quality services from them. But it's good to monitor this as well as an indicator, as part of the relationship. Other aspects can be accuracy of billing, the ease of doing business. Is it easy to negotiate? Are they responding to correspondence within a certain period of time? In case you have a ticketing system with them, or emergency system for sending emails, do they respond to this on time? Now, as mentioned, these aspects can be structured in a scorecard or in a dashboard, and ideally they need to be discussed with a certain frequency. On a monthly basis, I've actually dealt myself with organizations that were our suppliers, and we used to have a monthly meeting in which the supplier prepared a report, a scorecard, and they presented it to us as a customer. So as a customer, you should actually ask your suppliers to come up with it to facilitate this process, because it's a sign of professionalism on their behalf. And you would want to work with such companies. So yes, you can have such a review done on a monthly basis or on a quarterly basis. Supplier relationship management meeting in which you don't just talk based on opinions, you talk based on the data expressed in such a scorecard or dashboard. And I've actually worked with service providers that engaged me to assist them in establishing scorecards through which they wanted to assess themselves so that they could prove to their customers that they provide high quality services. So yes, so you can actually ask your suppliers to initiate such a process themselves. It shouldn't be just about you doing all the work. They should lead in a way themselves.
Okay, we're running short of time, so let me quickly jump to the new question. Ms. Omay Soleiman, can you hear us? You raised your hand earlier. Omay Suleiman. Hello. Okay, I believe you posted your question in the chat box, so let me read it also. What is the difference between a KPI and ratio?
Well, the ratio is a calculation done to measure a KPI. For example, the ratio of professors to students in a university. Let's say this is a KPI to use to monitor the quality of the educational service provision. Do we respect certain standards, certain ratios? Same in hospitals, ratio of doctors to nurses. In organizations, ratio to HR people or admin people to people that would work in production. So the ratio is a calculation that is done to monitor a KPI. Same as with calculating the rate, a certain rate. Now, initially we had a different symbol for ratio, but then we realized that in calculating the ratio, you have to divide two quantities. So you have to divide two numbers, or you have to divide numbers and then calculate the percentage as part of it. So ratios are expressed as a symbol through numbers or percentages. It depends on how you want the ratio to be expressed. Good. So it's a calculation in essence.
Okay. All right. Next question. Mr. Kareem Ullah, can you hear us? Mr. Kareem Ullah, can you hear us? Kareem Ullah. Kareem Ullah. Okay. Let me move to the chat box. I believe, folks, if you are raising your hand, so it means that I will be able to give you an opportunity to speak to Mr. Aurel, or you could put your question in the chat box and I'll read them over. Let me move to the chat box again. The question is, as a strategy planning and corporate performance management division in a bank, should we monitor performance indicators of all divisions, or is it enough to monitor only strategic performance indicators of a bank?
Well, the first question is, should the performance of all of these divisions be monitored? And my opinion is yes, it should be monitored. The second question is, yes, who should do it? Now, in case you have capacity and you train people, this can be done at the divisional level. So each division can assign, let's say, a performance champion, or a scorecard coordinator, or a dashboard coordinator, or performance reporting coordinator that would produce such performance reports on a regular basis. The scorecard on a monthly basis, the dashboard can be updated with a certain frequency. So the idea is that these reporting instruments, these tools, scorecards and dashboards, need to be owned by someone that guarantees that the data is produced on a regular basis. So if you have such resources available, yes, you can train these people, you can assign them and let them generate them and report and use them in their own divisions. If you don't have such resources available, then I believe, yes, you should pick up such a role and generate the reports for all the other divisions and even facilitate the meetings in which such reports are analyzed. So yes, I've seen that in organizations. At the National Australia Bank, as part of a project that I worked on, we implemented a balanced scorecard at organizational level for the entire bank, and then for retail banking, business banking, and for wealth management. So we took care of this aspect ourselves. We cascaded from organizational to divisional level. We produced the reports ourselves, and also we started having meetings with other teams in operations. Marketing were doing their own dashboard scorecards, HR, they had their own dashboard scorecards. So we tried to connect all these teams to form a community of practice so that people would gradually align their architecture to the organizational architecture. So in essence, yes, it's a good idea to cascade from organizational level to operational level and then further down to support teams. And in doing so, it's all about the type of resources you have available. If you don't have resources and train people in all these areas, you have to cover this from your central office, from the strategy management and corporate performance management office initially.
Okay, we'll take a last question, short one. Is self-appraisal an internal KPI?
Well, Self-appraisal of what? Again, according to the definition of what a KPI is, it's supposed to be a measurable evaluation of something that is relevant to the business. So in terms of employee performance management and the use of employee of KPIs at employee level in employee performance assessments, I've noticed two approaches. One is the use of generic statements that are evaluated on a scale from 1 to 5. Is this person a good team player? Is this person supporting, let's say, good communication in the team? Evaluated from yes, well, from to a low extent, medium, high, very high extent, something like that. So there are organizations who use such sentences evaluated on a scale from 1 to 5 to assess the performance of staff. Now, I look at this as, yes, assessment performance criteria, but I don't call them KPIs. To me, KPIs are actually the figures that we put in employee performance plans that are cascaded from organizational level. An example would be the sales manager would definitely have to have as a KPI the sales revenue generated by his team, not just by himself, by the team. So he needs to take responsibility of the results of the team. A recruiter, I've worked with organizations which have internal recruiters, teams of, let's say, 17 recruiters. A recruiter should be evaluated by the time it takes to recruit, the costs to recruit for the positions that he recruited on, but also the quality of the recruitment process. So the performance assessment or the feedback received, let's say, 3 or 6 months after the recruitment was completed from the manager of that person, how happy are they with the way this newly recruited person performs. So these are examples of KPIs that should be listed in employee performance assessments to ensure that when you evaluate the performance of employees, you reflect the performance of the team and of the organization. You don't want to be in a situation where you evaluate based on generic statements the performance of employees and everybody is an excellent performer, while at the same time the team has a terrible performance record and the organization is losing money. It's underperforming and it's into losses. So you want to ensure that the performance of the organization, the performance of the team, reflected through KPIs, are cascaded even further at employee level through such KPIs. At employee level, I've seen you don't have to have lots of KPIs cascaded. So yes, you might have, let's say, 20 KPIs for the department, for the team. At management level, you might have the manager of a team with, let's say, 8 to 10 KPIs maximum. Frontline employees might start with only 3 KPIs. On average, we might have 5 or 6 numerical KPIs, so quantitative KPIs, proper KPIs in place in such employee performance assessment forms. So in terms of self-assessment, well, in case you have such KPIs, numerical KPIs, like quantitative KPIs in your employee performance assessment, as an employee, you can measure this by yourself. You can keep track in a spreadsheet of number of positions you recruited, how long it took you, and what was the average. You can keep track of number of innovation ideas that you submitted. So yes, you can self-assess and provide these numbers to management. Now, in many organizations, this level of maturity around employee performance management hasn't been reached yet. So they are still measuring based on subjective criteria. What I would encourage in this case is just to gradually move, maybe combining the two initially and then gradually move towards assessing employee performance not with sentences and with ratings, but assessing based on the achievement of certain numbers.
Okay, well, I've been requested to just read these last 2 questions. The one is, what should be the frequency of reviewing KPIs? And the second one, is there any highly automated software tool that you would recommend for KPIs?
Certainly. In terms of the frequency of reviewing KPIs, it depends on the definition of reviewing. We generally use reporting. Yes, the reporting frequency, in case we are talking about a scorecard, should be monthly. I would recommend monthly. Some organizations do this quarterly, but I would recommend reviewing your scorecard on a monthly basis, the progress you're making in achieving your objectives on a monthly basis. Why? Because you have more chances to improve. Reporting is all about improvement. If you report once a year, you're actually not really managing. If you report on your scorecard twice a year, you only have one chance to improve. You report halfway through the year, so you have 6 more months to improve. If you report on a quarterly basis, you have 3 chances to improve. While if you report on a monthly basis, you have 11 chances to improve. So scorecards should be reported on a monthly basis in essence. Dashboards, well, it's a different story here. Some dashboards are monitored live. For example, call centers have KPIs that are reported live in their environment, and they make immediate decisions. Also, Google Analytics is a tool that provides live data to number of visits, but the bounce rate on your website, how many people actually leave the website within 30 seconds of getting there, that is the bounce rate. Also, a number of pages per visit. So there are lots of indicators that are reported live. So dashboards should be reported with a very high frequency, as high as possible, live, daily, weekly, because it's all about decision making, and we need to be ready to open up the dashboard and look at the data whenever we need to make decisions on the spot. So that would be the answer to the first question in terms of reporting frequency. In terms of reviewing, according to my definition of reviewing, I look at reviewing as actually looking at, are they the relevant KPIs? Do we like them? Do we have to change the name, the definition, these sort of things? Now, a partial review can be done each month, because when you talk about KPIs, you will make some decisions, so you have to update the KPI definition, the KPI documentation form. So a partial review can be done in such context. Other than that, I would encourage organizations on a quarterly basis to take a look at their strategy. Are our objectives, are our KPIs still relevant in the context in which we operate? Because these days, the environment in which we operate changes often. So there may be value in looking, let's say, spending half a day, spending 1 day once a quarter to do an overall review of your strategy as you're progressing with it. And finally, a review can be done also at the end of the year as part of the rollout of the new plan, the new, let's say, strategy for the next financial year. Yes, you would have to review whether your KPIs are still accurate. So that's how I would separate the two terms. Reporting, it's about looking at the data, making decisions based on data. Reviewing is about analyzing the relevance and the accuracy of using KPIs. Good, so that's the first answer. Second answer around software. There is, well, traditionally we start with Excel, because it's a lot more easier to start with Excel. You can configure things quite easily. You can change things quicker. It doesn't cost money. People don't have to be trained in terms of looking at the data. However, indeed, Excel has lots of limitations in terms of data accuracy, in terms of how complicated it can get, in terms of data reporting. So we started looking at some options of software that fit well with our architecture. And our favorite option at the moment is the software that we actually set up a dedicated website. It's produced by Spider Strategies. It's a US-based company. Scoreboard, Quick Score, so they have two different brands that they operate. Now, if you go to, I think the website is software.integerperform.com. We have a demo there of this software solution. So I don't know if this link can be shared, but we have a website where we have a variety of clips that illustrate.
If you can send me the link, I'll broadcast to everyone on the participants and the chat box.
Okay, great. So let's do that. I will provide this link, and you have a variety of clips and demo and pricing, and you can take a look at how it's operated. Yeah, so that would be the answer to the question.
Okay.
So I've just pasted 2 links. One of them contains the presentation, the other contains a demo section. So you can log in and explore how this software works. And demos can be arranged, I think 30 days demos can be arranged, so you can create your own scorecards dashboards with this software in your own environment, secure environment, to just see how it might work in your context.
Okay, brilliant. So that really brings us towards the end of the webinar. I would like to thank Mr. Brudan on behalf of MILE for your time and willingness to share the valuable information and experiences with our participants. Also, thank to all of you who participated. We are glad you could join us and hope the session was helpful for you. We will be emailing you the link to a recorded version of this webinar in a couple of days once it's updated on our YouTube channel. as well as the link towards the soft copy of the presentation to download. Just to conclude, based on note that Mr. Aurel Brudan will be conducting a second session of the webinar on selecting key performance indicators on January 2nd at 5 p.m. Saudi Arabia time. You all shall be receiving an invitation from us with the registration link. Again, you would have to register. In the meanwhile, if I just take the rights from you, Aurel, just to show the screen, share my screen once again.
Sure, please do.
Okay. Folks, if you can see my screen, where we are basically having a certified KPI professional training course on 13th to 15th of January in Riyadh, Saudi Arabia. And Mr. Brudan will be running the whole program for us, the training course, and we are open for the registration right now and accepting the applicants. So you can visit our website www.mile.org/KPI. So you will get all the details about this program, the course content. You can download the brochure, or even if there's a request for an in-house training, you can fill out the form and we shall get back to you. But in the meanwhile, Aurel, once again, thank you very much for your time. Apologize, I mean, we had a 60-minute agreement, but we have surpassed to almost an hour and a half, and we really appreciate that you've given us this time.